Hi, this is Fred Soroka with Golden Gate University. Today is November 17, 2017, and as of last night, both the House of Representatives and the Senate Finance Committee advanced their proposed tax legislation, H.R. 1, and the chairman's mark of H.R. 1. What we hope to do in this slide deck is give you a brief summary of what we're seeing as the changes to business taxpayers and provide not a complete summary, not a detailed analysis, but some suggestions of things that should be discussed with your client where they might want to take action before the end of the year. If we take a look at the proposed changes to corporate tax rates, this is pretty straightforward, right? Instead of 35%, the House has said let's take virtually all corporate taxpayers down to 20%, with the exception of personal service corporations. Think doctors, lawyers, accountants, engineers, architects, etc. The Senate pretty much agrees, except they're not so concerned about being mean to doctors, lawyers, etc. Very few of us operate in C Corps anyway. However, the Senate, in order to make sure that they meet that $1.5 trillion ceiling, have proposed waiting 1 year before dropping the corporate rates. The Senate also reduces the value of the dividends received deduction if you own less than 100% of a subsidiary, to take into account the fact that there's going to be a lower tax rate in your topco in the company that's going to wind up receiving the dividend from a lower tier corporation. Well, that's a pretty dramatic savings. It almost cuts in half the federal tax. Some people have asked the question, should we change flow-throughs over into C Corps? We'll talk a little bit about modeling, but by the time you add state tax in, and if you do distribute the money and you have to pay tax on the dividend, the income flowing through a C Corp still won't give as much into the hands of the individual owners. However, if you're leaving the money within the business and your state tax isn't too oppressive, could easily be an alternative that people will consider. The second thing to consider is how rapidly can businesses write off the cost of any new equipment that they buy. The House proposal is pretty straightforward. Just write off everything that you acquire after September 27, 2017. What's bizarre is the House proposal also applies to used property. I don't see where that benefits the economy whatsoever. It doesn't put more business property into the economy. There are a few limitations on utilities and what they call real property businesses. When you take a look at the dollar amount, $5 million was the House proposal. That's incredibly high, especially compared to what was currently a $500,000 limit. The Senate is coming down to just a $2 million limit. And then when you take a look at the phase-outs, you can again see that the House version is far more liberal. There's also an expansion of the definition of what qualifies for 179 property. Senate has a couple of other proposals, such as slightly shortening the depreciable life for residential real property down to 25 years from, I believe it's 27.5 right now. And we've had 10-year depreciation for restaurant property and certain leasehold property. The Senate has proposed increasing that. The short version, though, is to the extent that someone acquires property, worry about acquiring it still in 2017. By the time this gets through committee, it might easily be 2018. Be stunningly hard for the IRS to change tax forms at the last moment. So I'd worry about any acquisition in late 17, would consider deferring until 2018 if you don't believe you're going to get current write-off of the acquisition. Both House and Senate have a number of provisions which are designed to help small businesses. Now, this will apply whether it's a C Corp or whether it's a flow-through, an S Corp or a partnership. What's a small business? There's a slight difference in terms of the definition. 25 million in the House, 15 million in the Senate. I'd be willing to bet up to a nickel that 20 million will be the compromise if this becomes law. The first suggestion is that the use of cash method should be expanded. Currently, Code Section 448 limits C Corps on their use of the cash method. I believe that the expansion, particularly the expansion to include inventory, could be a significant benefit if the cash method winds up being simpler, easier to apply. A couple of other changes that were really valuable. Those uniform capitalization rules where you need to pick up a bunch of additional costs, whether you're building inventory or whether you're building other property that you're going to use in your business, those won't apply anymore. Long-term contracts, we've had to pick them up ratably as we perform the services. Maybe we can use the completed contract method. And finally, we'll see a fairly aggressive limitation on the deduction of corporate interest expense. Again, for little kids, businesses under this threshold, maybe they can avoid those limits as well. That would be for C Corps. Let's talk about that interest expense limitation. The real challenge that we're running into here has to do with the use of a lot of leverage to reduce the current high U.S. corporate tax rate. So what's been proposed is that if you have a business that's big, again, the $25 million or $15 million, we're going to try to limit your ability to deduct interest. Curiously, this isn't just C Corps. The House proposal, and I believe the Senate Finance Bill, apply to any flow-through business, so S Corps or partnerships as well. What's the limitation? The limitation is your interest income, so you can net interest income against interest expense. And then your remaining interest expense can't exceed 30% of your adjusted taxable income. What's adjusted taxable income? Well, it's all your taxable income. You don't include net operating losses, and you try to mirror EBITDA, meaning that you eliminate your depreciation, amortization, depletion. When you take a look at those, the exclusion of interest income, I think there's a difference between the House and Senate version that I pointed out. I didn't think the difference was all that substantial. Now, by putting this limit on, it's possible that the current limits that we have, whether a HIDE or the related party under 163J, those could be repealed. But for businesses that are heavily leveraged, looking forward into 2018, they may be challenged to shelter their income. So this is a significant reduction of the benefit of the 20% proposed tax rate if you are a heavily leveraged business. There are more provisions than that, though, for businesses. Like-kind exchanges, well, they're used most heavily in the real estate industry, but we know that airlines, car rental companies also do like-kind exchanges of tangible personal property. The proposal at the House level, and I believe it's in Senate Finance, limits that to real property. So your exchanges of personal property will wind up being taxable. Remember that when you trade a hotel, an apartment building, you probably have a huge amount of tangible personal property in there. So it will also impact the real estate business, is my best read of that provision. A few fancy rules with respect to SBICs, not very broad application. Several mean rules to try to attack inventors. Obviously, we have too many people applying for patents in California, and California is a blue state. And a very curious proposal that's in the Senate Finance version, which says that tax revenue recognition will stay under its current tax rules unless financial accounting picks it up earlier. So the proposal suggests that we have to recognize revenue for tax purposes the earlier of when we pick it up in our GAAP financial statements or when we have to pick it up under standard tax rules. We'll talk a little bit about what that might mean to some of our clients who are going to be hit with the revenue recognition changes in the next year or two. In terms of deductions, net operating losses, the limitation, it's been proposed to mirror the current AMT approach, where you wind up having to pay tax at basically 2% coming through. So limit to 90% of current year income, and then that'd be subjected to a 20% tax to give you kind of the same result as previously what AMT would do to your loss carry forwards. Anyone who's dealt with GoFundMe or has dealt with state credits and incentives know that when you get contributions into your capital from shareholders, that's not taxable because of Code Section 351. But Section 118 says you can take money from other people and maybe not have to pay tax on it. The service has gotten mad and said, wait a minute, if you just get it from the general public, like GoFundMe, maybe that's taxable income to you. It's uncertain exactly when Section 118 will exclude those contributions to capital without equity from your taxable income, when they won't, no matter what. Both House and Senate propose repealing that. Lobbying deductions, we've always had a fairly strict limitation, but it didn't apply at the local government level. That's going to happen. And the domestic production deduction, the 9% additional deduction under Section 199, that's proposed to be repealed just to clean things up. How about entertainment and fringe benefits? We'll blame the NFL for this one, but you can still deduct your meals the way that you used to be able to, 50%, but you can no longer include entertainment. So the M&E deduction is just going to become an M deduction if this goes through, and it's pretty much any entertainment, amusement, or recreation facility. Again, to the extent that you can prepay a little bit of those in 2017, might be decent planning. A long list of fringe benefits are on the chopping block to be eliminated as well. This is again to make payment for all of those things. What's curious is eliminating deductions for nonprofits doesn't help a great deal. So what we see is proposals that actually suggest if nonprofits give these fringe benefits, they're going to have to pay tax as if it was unrelated business taxable income. Bizarre, isn't it? Making a nonprofit pay tax on things that it pays for its employees. Bunch of other changes. Don't worry too much about the partnership change. That's only intended to be mean to foreign taxpayers. There was a revenue ruling that said foreigners have to pay tax when they sell their partnership interest. The tax court disagreed. Grecian Magnesite, I think, was decided in July of 2017. And the Senate has proposed to reinstate 9132, since that would generate money and foreigners don't vote in our elections. Changes to how companies can issue bonds and whether or not the interest will be taxable. Changes to insurance companies. What's curious and scary are the changes being made to compensation plans. Non-qualified deferred compensation plans are subject to some fairly substantial attack where they may be taxable as soon as they vest. Now, I'm a retired Big Four partner. My wife is a retired Big Four partner. Our firms have promised to pay us money for the rest of our lives because of our prior service. It's an unfunded plan. It's clearly non-qualified deferred compensation, but it's being paid because of our prior services triggered by our retirement. So it's not taxable. It's not a bad thing under Code Section 409A. The proposal, however, would say on a go-forward basis, those plans won't work, and worse, will wind up with all of our pre-2018 services, so basically my entire retirement, being taxable to me in the year 2026. Why 2026? Because that's a whole bunch of revenue that can be modeled into the 1.5 trillion cap. Let's hope that there's a different Congress in place before then, or else I may be going out to my faculty and asking for loans to pay my taxes. Finally, compensation for highly paid executives. You know, public companies have always had that $1 million limit on what they can pay their CEO, CFO, a few other of the top executives, but it was fairly easy to get around it by paying incentive compensation. My recollection is that's in 162M. Well, the proposal would say we're going to eliminate all those incentive comps and simply enforce the $1 million flat limit. That will certainly put some pressure on senior executives in large companies. The next thing to talk about is business credits, and it's a fairly simple slide. If your client is claiming any business credits, smoke them while you got them. A huge number of credits will simply be repealed. Where does this leave us? Well, let's begin by asking the question, how likely is the legislation to pass? I don't have a good guess. Again, I mentioned at the start that others are estimating as high as 80% probability of something passing. What we do know is that for either flow-through entities with business income, they might go down to a 25% tax rate. For C Corps, they might go down to a 20% tax rate. So deferring business income and accelerating business expense sure sounds like it makes a lot of sense. Second, depreciable property. Well, if you can deduct it in 2017, it'd be better to deduct it against the higher tax rates we have today. However, if you'd need to capitalize it, depreciate it over a period of time, you might think about deferring those major purchases because of the potential for very liberal write-off opportunities under the new rules. If you're trading away depreciable personal property, if that gets eliminated, you might want to try to close that by December 31. Again, relatively few taxpayers are going to have that problem. One big issue for clients that prepare audited financial statements is the rules with respect to the tax provision. What used to be called 109, that's now ASC 740. If there's a change in the tax law, you need to take it into account in the year of the change. Let's think about what's going to happen in the international environment where we see a dramatic inclusion of all of our offshore reinvested earnings and profits. And let's think through the repricing of our deferred tax assets based on a change in corporate rates. There could be a huge amount of work that needs to be done. You need to model it in time to be able to release your financial statements. But if this becomes law before January 1, 2018, all of the impact, both domestic and international, need to be taken into consideration. We discuss the international issues in a separate little recording. Finally, if corporate rates really do go down to 20%, is it worth checking the box on a single member LLC? Is it worth revoking your S election and just having the corporation sit on the money? Well, not if you're going to pay it out to yourself, I bet. If you want to take the money out of the business entity, it would probably be a dividend, and by the time you take the corporate tax rate plus the tax on the dividend, add in some state tax, maybe 2 levels of state tax. I don't see a huge push there, but modeling it for businesses that will be retaining the money to grow the business, I could see a significant amount of work. The issue is the decision needs to be made by March 15. Both the S election, the revocation of the S election, and the check-a-box have to be made within 2.5 months of the start of the tax year to be effective January 1. We're all going to be pretty busy in February and March, so it might be worth doing some modeling before the end of the year. Revenue recognition. We know that public companies need to adopt the new GAAP revenue recognition rules before private companies by 1 year. But to the extent that in 2018, the tax law says we need to pick up taxable income earlier because that's when we pick it up for financial statement purposes. Gee, if we can early adopt the revenue recognition rules, we might want to change our financial statements 1 year early. Otherwise, we could get whipsawed where we have to pick up for tax purposes based on the current revenue recognition rules. Then when the revenue recognition rules change for GAAP, we'd need to ask the IRS for permission to change on a Form 3115. I'd worry about that, but certainly if you have clients who are looking at their revenue recognition, considering both tax and financial accounting now becomes incredibly important. Finally, executive compensation, what can we say? At this point, I would suggest that maybe you take a look at your year-end bonus structure a little more carefully, but we don't have enough certainty as to what we can advise in terms of revising plans. Maybe a little bit of modeling and a lot of anxiety. That's about it for recommendations. If you have suggestions or if you see things that you think we should push out, please feel free to give me a call. My phone number and my email are on the first slide. Thanks.